afternoon, everybody. Today, our discussion would be concentrated on Block 4, and the Block 4 is titled as Financial Statement Analysis. Financial statement analysis means we need to analyze the financial statement of any business house or any business organization. In a common manner, by financial statement, we mean there are two major components in it. One is the income statement, and the second one is the balance sheet, which is otherwise called the financial statement. Income statement means the trading account, the profit and loss account, and in some cases it may include the profit and loss appropriation account. The transactions below the line, they are incorporated in the profit and loss appropriation account. So income statement is divided into three components: trading account, and if the organization is indulged in production or manufacturing activities, before trading account, we will need to prepare the manufacturing account. So there are four components involved in the income statement. The first one is the manufacturing account, then trading account, then profit and loss account, and the last one is the profit and loss appropriation account. These are the components of the income statement. The second part of the financial statement is the balance sheet. Balance sheet, which speaks of the statement of assets and liabilities of the organization. And if we look to the annual report, beyond these two major financial statements, that is the income statement and the balance sheet, the cash flow statement is also become a part of this as per the provisions of Accounting Standard 3. So, financial statement analysis, it refers to the process of determining financial strengths and weaknesses of the organization by establishing a strategic relationship between the items of the balance sheet and profit and loss account and other operative data. Two things are included in it. One is the analysis, another is the interpretation. Analysis means simplification of financial data by methodical classification, and by interpretation we mean explaining the meaning and significance of the data so simplified. So both analysis and interpretation are, however, interlinked with each other, and analysis is useless without interpretation, and interpretation without analysis is not only difficult but even impossible at times. So financial statement analysis are done with two ways. One on the basis of materials used, the second one on the basis of modus operandi. Before going to the discussion of financial statement analysis, let us have some more discussion. Let us give some more light on the financial statements. The first one is the income statement. The income statement, which starts from the manufacturing account when the organization is indulged in production or manufacturing activities. The resultant of the manufacturing account is the determination of the cost of production. The cost of production is the resultant of the manufacturing account. And after preparation of the manufacturing account, we need to go to preparation of the trading account. Trading account means it is the tabular presentation of the equation of gross profit. Equation of gross profit is what? The gross profit is equal to the sales minus cost of goods sold. Sales means the net sales. Gross sales minus, if there is any sales return, then that has to be deducted from the gross sales. That would be the net sale will be arrived at. And by deducting the sale cost of goods sold from the sale proceeds, from the net sale proceeds, it will give rise to the gross profit. The cost of goods sold is having an equation. It is the opening stock or stock at the beginning plus purchases made during the period. Purchases means the net purchase. If there is any return on account of purchase or return outward, then that has also to be deducted from the gross purchase, then the net purchase will be arrived at. Net purchase has to be added to the opening stock. Then direct expenses has also to be added. Direct expenses means all the expenses incurred for bringing the goods from the place of purchase to the place of effecting sales. And after inclusion of opening stock plus purchase plus direct expenses, then the closing stock or the stock at the end has to be deducted therefrom to find out the cost of goods sold. And when the cost of goods sold is deducted from the said proceeds, it would be the gross profit. So truly speaking, the final equation for the gross profit would be sales plus closing stock minus opening stock minus purchase minus minus direct expenses. That was the resultant of the gross profit. So if we analyze the equation of the gross profit, two items are coming with a positive symbol, that is sales and closing stock. And opening stock and purchase and direct expenses, they are coming with, these three items are coming with a negative symbol or negative sign. So when these two categories of figures with positive symbol and negative symbol are placed in a tabular or represented in a tabular form, that gives rise to the trading account. That means in the trading account, in the credit side, the sales and closing stock are being placed. And in the left hand side or in the debit side of the trading account, the opening stock, purchases, and all direct expenses like your carriage in wood, wages, octroi, all these things have to be included. And the resultant, if the balancing figure comes in the debit side of the trading account, then it would be gross profit, because the sales, the revenue, that means sales and closing stock is more than the opening stock and purchase and direct expenses. So it would obviously gives rise to the gross profit. It may so happen that the balancing figure may appear in the credit side of the trading account. When the balancing figure appears in the credit side of the trading account, it would be the gross loss, because the revenue falls short of the expenses. After preparation of the trading account, after determining the resultant of the trading account, either gross profit or gross loss, we need to go for preparation of the next financial statement or the next step in preparation of the income statement, that is profit and loss account. Profit and loss account itself is a nominal account. And nominal account is based on the principle that all losses and expenses are debited and all incomes and gains are credited. That is the basis, that is the fundamental principle of nominal account. Accordingly, the debit side of the profit and loss account contains all losses and expenses, and the credit side of the profit and loss account contains all incomes and gains. And the resultant of the profit and loss account is either the net profit. If the balancing figure comes in the debit side of the profit and loss account, that means the incomes are more than the expenses. So obviously it will give rise to the net profit. Or the balancing figure, if it appears in the credit side of the profit and loss account, then the expenses are more than the incomes. So the resultant would be the net profit, net loss. Profit and loss account is said to be the graveyard of all the nominal accounts. It itself is a nominal account, and it is said to be the graveyard of all the nominal accounts. That means graveyard means end of one's life. That means once the profit and loss account is prepared, means it brings an end to all the nominal accounts of the organization for that particular period for which the profit and loss account is being prepared. So once the profit and loss account is prepared, means it brings an end to all the nominal accounts of the organization for that particular period, and the resultant of the profit and loss account is either net profit or net loss for a particular period. It may be for a year, it may be for a quarter, it may be for a half year, it may be for a month, or even it may be for a day or a week. So these are the components of the income statement. That means manufacturing account, trading account, profit and loss account, and profit and loss appropriation account. The last component of the income statement is profit and loss appropriation account. That means if there is items like below the line transaction, like provision for income tax, provision for dividend, etc., the amount That means the items which are appropriation to profit, which are not charged against profit. That means when there is profit, then only there will be appropriation to profit. So in that case, the profit and loss appropriation account is to be prepared to find out the retained earnings, and that is the end of the income statement. After preparation of the income statement, the next financial statement is the financial statement, that means balance sheet, which speaks about the assets and liabilities of the organization. The left-hand side of the balance sheet contains all liabilities, and the right-hand side of the balance contains all assets. The balance sheet may be prepared in two ways, either on the basis of liquidity or on the basis of permanence. If the balance sheet is prepared on the basis of permanence, then the most long-term assets and liabilities would be the first item in the asset side and the liability side of the balance sheet. And accordingly, it will go down, and the last item in the liability side of the balance sheet would be the most liquid liability or the current liability. So also the case of asset side of the balance sheet. If the balance sheet is prepared on the basis of permanence, then the most long-term asset, fixed asset, and amongst the fixed asset, the land and building is the most long-term. That would be the first item in the asset side of the balance sheet. And the last item in the balance sheet, in the asset side of the balance sheet, would be miscellaneous expenditure and losses, which is coming under the category of fictitious asset. So this is about the financial statement or the income statement and the balance sheet. Then if we go for financial statement analysis, the first module of this block 4 is speaking about the understanding of annual report. Understanding of annual report means there are 4 components in the annual report. Annual report means the published account of any listed company or any company form of organization, a corporate form of organization. They used to prepare their annual report at the end of the year, which contains 4 major components. The first component of an annual report is non-audited information. The second one is financial statements. Third one is the notes on accounts. And the fourth one is the accounting policies. When we talk about the non-audited information, then the non-audited information may be of 2 categories. The first one may be narrative items, and the second one may be non-narrative items. Under narrative items, we will come across the items of the statements like the auditor's report, director's report, and chairman's message. All these things will come under the narrative items. And under non-narrative items, there may be graphs, there may be presentation of figures, graphical representation, etc., etc. They will come under the non-narrative items. And the second component of the annual report would be financial statements, as we have already discussed in detail. It may be the income statement. It may be the income statement means the trading profit and loss account, etc. And it may be the balance sheet, the financial statement, the balance sheet. And the next one may be the cash flow statement, which is a mandatory requirement for the listed companies, which must form part of the annual report of the listed companies. Then the third component of the annual report would be the notes on accounts. Notes on accounts means maybe disclosure of accounting policies. Disclosure of accounting policies may be regarding depreciation. Depreciation here we can say about depreciation means it is the gradual diminution in the value of fixed assets due to wear and tear, passage of time or efflux of time, or obsolescence. These are the 3 main reasons of charging depreciation. So depreciation, there are different methods of depreciation. There are the major item, the most widely acceptable methods of depreciation are straight line method and the written down value method, etc. So as per the conservatism convention of accounting, we need to the disclosure of accounting as per the conventions of accounting. There is the first convention of accounting speaks about the disclosure and materiality. So under this disclosure convention, we need to speak about the disclosure of accounting policies, then the valuation of inventories, revenue from operation, details of fixed assets and share capital, etc., directors' emoluments, earning per share, etc. That will form part of the notes on accounts. Then the fourth and the last component of the annual report would be accounting policies. Accounting policies means as regards the adoption of systems or policies to be followed. That means there are cash basis of accounting, there are accrual basis of accounting, there are hybrid systems. A part is cash accounting and a part is accrual basis of accounting. So there are mainly three methods of accounting. One is cash basis, another is accrual basis, and the third one is the hybrid basis. So which method of accounting we are following, which concepts of accounting we are following, for which purpose? Like there are different concepts. There are 10 concepts in accounting, and which concepts of accounting we are following and adopting as the policy of accounting for our particular organization. All these things have to be mentioned under the accounting policies, which is the end part of the financial statements. So on the basis of that, we need to understand the annual accounts or the annual report of the organization. So the first component of the financial statement is, it is about the understanding of the annual report. And the annual report, as we discussed, that the four major components of this, that is non-audited information, financial statement, which are basically audited accounts. Audited accounts means audited income statement, audited balance sheet, cash flow statement, etc. Then the third component is notes to the accounts, and the last one is the accounting policies. So when we took those information into consideration for making an analysis as we discussed, that there are two components involved in each one, is analysis and interpretation. Then the financial statements are done in two ways: on the basis of materials used, and the second one is on the basis of modus operandi, or on the basis of mode of operation. When we talk about the analysis of financial statement on the basis of materials used, it is of two types. One is the external analysis, another is the internal analysis. External analysis means it is done by the outsiders who do not have access to the detailed accounting records of the organization. Outsiders may be the investors, the creditors, the government agencies and credit agencies, and the general public, who do not have access to the detailed accounting information of the organization since they are outside. So when they are having limited accounting data, they can have the annual report in their hand, and from the annual report they can do the analysis. So they cannot do the in-depth analysis of the financial statements of the organization. That's why it is termed as the external analysis. In other words, the internal analysis means the analysis conducted by the internal people of the organization, that is the management, the employees who have access to the internal accounting records. So they can make a thorough analysis. The internal analysis can be done in a more thorough and a better manner than that of the external analysis. And on the basis of modus operandi, when the analysis of financial statements are done, it is of again two types. One is horizontal analysis and the other one is the vertical analysis. Horizontal analysis is otherwise known as the dynamic analysis, whereas the vertical analysis is known as the static analysis. Dynamic analysis means, or the horizontal analysis means, when the same and related items of one organization for different years are compared with each other and some result is determined, it is called horizontal analysis. That means The organization is one, the year is one, and items are different. That means for the same organization, for the one organization, different items which are related to each other for a particular year are taken into consideration for determination of any result. It is called the horizontal analysis. Under horizontal analysis, there are different under horizontal analysis, there are different tools available. Comparative, yes. Under horizontal analysis, there are different tools available. One is the comparative statement analysis, another is trend analysis, another is funds flow statement and cash flow statement analysis. Under comparative statement analysis, what is done? The elements of financial position are shown in a comparative form so as to give an idea of financial position at two or more periods. The comparison may be absolutely in figures, or it may be increase or decrease in figures only, or the increase or decrease of figures in form of percentage. And there may be comparative balance sheet analysis, there may be comparative income statement analysis even. When we talk about the comparative balance sheet analysis, it can be done. You can look to the figures given in the slide. Here, we can look to the assets first. It is fixed asset, then investments, then current assets. There are three categories of assets are given here. And the figures are given for 31st March 2005, the first year. And the next year is 31st March 2006, the next year. For the first year, the fixed assets is 6 lakhs. And for the next year, as on 31st March 2006, is 7,20,000. So the change in figure, that means increase in figure is 1,20,000. 7,20,000 minus 7,20,000. Excuse me, minus 6 lakhs. So the change in figure is 1,20,000. And when that change in figure is represented in form of a percentage, it comes to 20%. That means 1,20,000 divided by 6 lakhs into 100, it is coming 20%. That means the change in percentage, when it is expressed in form of percentage, it would be 20%. Similarly, when we consider the investments, the investment was 1 lakh as on 31st March 2005, and the investments became the same, it remains same at 1 lakh in the end of the second year also. So there is no change in figures is nil, and percentage change in figures is also nil. Then the third item and the last item under the asset category is current asset, which is 3 lakhs as of 31st March 2005. And as of 31st March 2006, it is 2,10,000. That means there is a reduction of 90,000 under the head current asset. So when we put the change in figures, the absolute change in figures, then it would be negative 90,000 because it is reduced from 3 lakhs to 2,10,000 in the second year. And when this change in figure is represented through percentage, it is coming 30% because this 2 lakhs, this 90,000 reduction divided by 3 lakhs into 100, it is coming 30%. So in total, when we consider all the assets into consideration, the total of assets was 10 lakhs as on the first year, as on the end of the first year. And it was 10 lakhs 30,000, it is as on the end of the second year. So in totality, the total of assets in change in figures is positive 30,000. And when that is represented through percentage of change in figures, that would be 3%. That is about asset. Then when you talk about the liabilities, there are 4 items in it. One is share capital, another is reserve surplus, third one is long-term loans, and the fourth and the last one is the current liabilities. Share capital was 5 lakhs as on the end of the first year, and the figure remains same as on the second year, as on the close of the second year. So neither there is any change in figure nor there is any change in percentage. Then this next item in the liability side of the balance sheet is reserves and surplus. Reserve and surplus is 1 lakh at the end of the first year, and it is 1,20,000 at the end of the second year. So when we put the figures as change in figure, it is about 20,000 increase. So positive 20,000 is mentioned in the change in figure. And when we talk about the percentage change, it is 20% in the percentage change in figure. So the long-term loans, the next item in the liability side is long-term loans. It is 3,000 in the first year as well as 3,000 in the second year. So no change either in figures or in percentage. The next item is current liability. It is 1 lakh as on the end of the first year, and it is 1,10,000 as on 31st March 2006, that means second year. So change in figures should be 10,000 positive because it has increased from 1 lakh to 1,10,000. So when you put it in the percentage change, it is coming 10%. And in totality, the total of liabilities is 10 lakhs at the end of the first year and 10,30,000 at the end of the second year. So the change in figures would be 30,000. That means increase, positive figure. And when it is put under percentage, it is coming 3%. So this is about comparative balance sheet. Comparative balance sheet. Accordingly, we can make a comparative income statement analysis. When comparative income statement analysis is taken into consideration, there are sales in the year 2004-05 it was 24 lakhs, and in the next year it is in the year 2005-06 it is 37 lakhs 50,000. So change in figure is 13 lakhs 50,000 increase. That is a positive flow, a positive increase in the figures of sales from the first year to the second year. When it is put as a percentage of change, then it will be 56.25% because 13.50 divided by 24 lakhs, 13 lakhs 50,000 divided by 24 lakhs into 100, it is the percentage is calculated like 56.25%. Then from sales, in the income statement from the sales, the cost of goods sold has to be deducted to determine the gross profit. It is done here accordingly. So 24 lakhs, the cost of goods sold is 20 lakhs for the year 2004-05, and for the year 2005-06 it is 25 lakhs. So the change in cost of goods sold is 5 lakhs. So in the change in figures column, absolute change in figures, it is coming 5 lakhs positive. And when it is put in form of percentage, it is coming 25%. When this cost of goods sold is deducted from the sale proceeds, we are arriving at the gross profit, and the gross profit is coming 4 lakhs for the year 2004-05, and it is coming 12 lakhs 50,000 for the year 5-6. So the change in figures as regards gross profit is, it is 8 lakhs 50,000. 8 lakhs 50,000, it is positive because it has increased from 4 lakhs to 12 lakhs 50,000. And when you calculate the percentage of change in figure, it is coming 212.50%. So after gross profit, we need to arrive at the net profit or the profit after tax. For that, we need to deduct the indirect expenses, and indirect expenses is said to be 10% of the gross profit. So the gross profit is 4 lakhs here. So the indirect expenses would be 10% of 4 lakhs, that means 40,000. And for the second year also the same principle is applicable. When 12 lakhs 50,000 is the gross profit, the indirect expenses would be 10% thereof, that means 1,25,000. So 40,000 is the indirect expense for the first year and 1,25,000 is the second year. So the change in figures is 85,000 positive, that means increase by 85,000 in comparison to that of the previous year. And when that is calculated in form of a percentage, it is also coming 212.50%. So when the indirect expenses are deducted from the gross profit, the profit before tax is being computed. It comes to 3,60,000 for the year 2004-5. That means 40,000 deducted from 4 lakhs. It is 3,60,000 for the year 2004-5. And for the year 2005-6, it is coming 11,25,000 when 1,25,000 is deducted from 12,20,000. So when we calculate absolute change in figures of profit before tax, it is coming 7,65,000. 7,65,000 when it is put under percentage, it is also coming as 212.50%. That is the profit before tax. Then income tax has to be deducted from the profit before tax in order to find out the profit after tax. So when the rate of tax is 50%, so 3,60,000 is the profit before tax for the year 2004-5. So 50% is deducted there from 1,80,000 is deducted. So profit after tax is coming to be 1,80,000. And for the second year, that means for the year 2005-6, the income tax is coming 5,62,500 being 50% of 11,25,000. So when we find out the income tax for the year, for the first year it is 1,80,000, for the next year it is 5,62,000. So there is an increase. The amount of income tax is 3,82,500. That is the absolute change in figures. And when we calculate the percentage thereof, it is also coming to the same figure, same item, to 212.50%. Then after deducting the income tax component from the profit before tax, we are arriving at the profit after tax PAT. That is also coming 1,80,000 for the year 2004-5 and 5,62,500 for the printing mistake. That would have been the 5,62,500, the profit after tax. And the difference would be 3,82,500. When the 5,62,000 minus 1,80,000, it is coming 3,82,000. That is the absolute change in figures. And when you calculate the percentage thereof, it is also coming the 212.50%. That is the profit after tax. So this is about comparative income statement analysis. The next tool under the horizontal analysis is trend analysis. Trend analysis is the meaning of the trend analysis is figures of the same nature having linked with each other for different consecutive years are compared, taking the first year figure as base. First year's figure has to be taken as base, and it may be taken as 100, and accordingly the percentage has to be calculated. This method determines the direction upwards or downwards and involves the computation of the percentage relationship that each statement item bears to the same item basing on the base year. The figures of the first year or the base year is taken as 100, and the trend ratios for other years are calculated on the basis of base year, whereby the trend is determined as upward or downward. Here, the related items are to be taken for comparison, and if they are not having any relationship with each other, then the calculation of trend analysis will be of no use. So here, two related figures are taken. One is the sales and the stock. Stock means stock of finished goods. Year is taken as 2000, 2001, 2002, 2003, and 2004. 5 years have been taken. And amount of sales for the year 2000, it is 18 lakhs. And for the year 2001, it is 20 lakhs. In the year 2002, it is 24 lakhs. And the year 2003, it is 30 lakhs. And in the last year, that is in the year 2004, it is 36 lakhs. That means it is in a continuous increasing trend from year to year. So the second related item taken into consideration along with sale, that is stocks. That means the amount or the volume of sales is dependent on the quantum of stock we are having, because the customers will have to exercise their choice accordingly. When we are having more stocks, obviously the sales are supposed to be more. So stock is the second related items taken into consideration here for purpose of trend analysis. For the year 2000, the stocks was the quantum of stocks were 3 lakhs. For the year 2001, it was 4 lakhs. For the 2002, it was 5 lakhs. For the year 2003, it was 6 lakhs. And for the year 2004, it was 7 lakhs. When you calculate the trend, let us calculate the trends for the sales for the past year. When it is taken as 100, the base year is 2000. And for that year, the trend is fixed at 100%. The amount was 18 lakhs. So for the second year, that means for the 2001, the sales is increased to 20 lakhs in comparison to the sale of the base year as 18 lakhs. So the trend is 111%. The calculation is 20 lakhs divided by 18 lakhs into 100. 20 lakhs is the sales during the next years or the second year. In comparison to the base year of 18 lakhs, so it became 111% in comparison to 100% in the base year. Accordingly, for the year 2002, when the volume of sales is 24 lakhs, it is about 133% of sales in comparison to that of the base year, that is 2000. In the base year, the sale was 18 lakhs. The formula for the computation of the equation is 24 lakhs divided by 18 lakhs into 100. It is coming about 133%. So the trend for the first year was 100%, trend for the second year was 111%, and the trend for the third year on account of sale is 133%. In the same manner, when it is computed for the year 2003, it is coming, the figure is 30 lakhs. That means 30 lakhs is the sales in comparison to 18 lakhs of sales in the year 2000, which is the base year. So when you calculate the percentage trend, it is coming to 167%. 167% in comparison to sale of 100% in the first year, that is 2000, when the volume of sale was 18 lakhs. Accordingly, for the last year or for the year 2004, when the sale was 36 lakhs, we can compute it is 200%, or just double the sale of the base year, that is 2000. In the year 2000, the amount of sale was 18 lakhs. In the year 2004, the volume of sale is 36 lakhs. So it is just 200%, or twice of the sale in comparison to the that of base year. So the trend percentage is expressed as 200. So in the first year, it was 100%, which is the base year. In the second year, the trend of sale was 111%. In the third year, the trend was 133%. In the fourth year, it was 167%. And in the fifth year, it was 200%. So the sales are always in the increasing trend, and in the trend is also in the increasing rate. That means in the first year, the increase is about 11%. In the third year, the increase is about 22%. And in the fourth year, the increase is about 34%. And in the fifth year, the increase is about 43%. It has jumped from 167% to 200% in the final year. So this is the trend of sales from the year 2000 to 2004. Let us come to the stock and determine the trend in stocks or in the closing stocks from the year 1 to the year 5. In the first year, it was 3 lakhs. In the first year means in the year 2000, it was 3 lakhs. In the year 2000, it was 4 lakhs. In the year 2002, it was 5 lakhs. In the year 2003, it was 6 lakhs. And in the 2004, it was 7 lakhs. So when we calculate for the base year, that means for the year 2000, it would be 100. And for the next year, that means 2001, the trend percentage would be 133%. That means in comparison to the 3 lakh sale in the first year, in the year 2000, it has increased by 33%. So the trend percentage is 133%. Accordingly, when calculate the same for the year 2002, it is coming 167%. That means the increase is about 34%. In the fourth year, that means in the year 2003, the quantum of stock was, the value of the stocks was 6 lakhs rupees. So the percentage of increase goes to 200%. That means it is in the fourth year, the stocks became just double of the stocks of the base year. The trend was 100 in the first year and the trend became 200% in the fourth year. And in the fifth year, on the final year, in the year 2004, the stock was 7 lakhs, and in the base year it was 3 lakhs. So the percentage of the trend became 233% in comparison to that of the base year, that is 2000. Right? So the increase of the trend of increase in the stocks is 100 in the first year, 133 in the second year, 167 in the third year, 200 in the fourth year, and 233 in the fifth and final year. So the sales were increasing, the stocks are also increasing, but if we make a comparison between the two, the increase in the volume of stocks or in the value of stocks is more than the percentage trend of increase in the sales. Sales has been increased at a lower rate than that of the stocks. Stocks have become double in the fourth year, whereas the sales have become double in the fifth year. So this is the result of the trend analysis. Trend analysis is a part of the horizontal analysis, where the figures of the same organization for different years are compared with each other for determination of certain results. There are two other components, two other tools coming under this horizontal analysis, that is funds flow statement analysis and cash flow statement analysis. Since they are lengthy in nature and they require special attention, we'll discuss in our next session. Let us complete the vertical analysis here, which is comparatively a smaller topic and it can be covered in the today's session. The vertical analysis is otherwise called the static analysis. The different items of one financial year of a particular organization are compared with each other and some result is determined. In case of a vertical analysis, the figures of one and the same year are considered of the same organization, whereas in case of horizontal analysis, the figures of different years of the same organization was being considered for determination of the result. So what are the tools available under this vertical analysis? The common size statement and the ratio analysis. Common size statement means under this method, the balance sheet and the income statements are shown in analytical percentage. Total assets figures should be taken as 100. That means the whole of the assets. It may be fixed assets, it may be current assets, it may be fictitious asset, it may be loans and advances. Composition of all the assets are taken as 100. And composition of all the liabilities are also taken as 100. And this total component of the asset, when it is taken as 100, its different components are divided amongst the individual assets or the individual items of assets. The same principle or the same thing or the same method is adopted in case of liabilities, incomes and expenses also. Here, from this example, let us see that the fixed assets, there are three items under fixed assets. Fixed assets means the assets which are used on long-term basis and the benefit from which are derived in a series of future years. So the first item coming under the fixed assets is a land and building, which is 10 lakhs. And the plant and machinery is 4 lakhs. And the furniture and fixture is 50,000. So the total of fixed assets is coming 14,50,000, and the current assets are inventory 2,50,000, debtors 2 lakhs, and cash and bank balance 1 lakhs. It is coming 5,50,000. The total of current assets is 5,50,000, whereas the total of fixed assets is 14,50,000, and the grand total of assets is coming 14,50,000 plus 5,50,000, that is 20 lakhs. So the total of assets, that means 20 lakhs, has to be considered as 100, because the whole of assets, all categories of assets, the grand total of assets is coming to be 20 lakhs, which is considered to be 100. And each item of assets are to be divided accordingly into different percentage, comparing the total to be 100. So when the total of assets is 20 lakhs and the first item of fixed assets is land and building, the amount is 10 lakhs, it would be obviously the 50% of the whole of the assets. So under percentage, the figure 50 has been shown. And plant and machinery is 4 lakhs, so it is 20% of the total of assets. Total assets being 20 lakhs. And furniture and fixtures, it is 50,000 only, so it is coming 2.5% of the total assets. So the total of fixed assets is coming to be 72.5%. And when we consider the current assets, the inventory is 2,50,000, and in comparison to the grand total of the assets, it is about 12.5%. And the debtors, which is another current asset, with the figure is 2 lakhs, it is coming 10%, because the total or the grand total of the whole of the assets is 20 lakhs, so it is coming 10%. And cash and bank balance is only 1 lakh. Cash and bank balance is 1 lakh, so that is about 0.5% of the total assets. So current assets, the summation of current assets in form of percentage is coming to be 27.5%, and the same for the fixed assets is coming 72.5%. So when both are included together, it will be also 100%. So here the total of common size statement speaks about the that means the percentage of land and building is about 50% of the total of assets. The percentage of plant and machinery is about 20% of the total assets for that particular year, and the percentage of furniture and fixture is coming 2.5% of the total year of the total assets, and the inventory is coming 12.5% of the total assets. The debtors is coming 10% of the total assets, and the cash and bank balance, which is also a current asset, is coming about 0.5% of the total assets. So this is about common size statement. The common size statement, this is about the common size statement in respect of the balance sheet. The common size statement can also be prepared in respect of income statement. In case of income, the all incomes, the total of income, that the grand total of income need to be taken as 100, and different items of income are to be segregated accordingly depending upon the amount it carries. Then in case of expenses also, the whole of expenses are to be taken as 100, and different items of expenses are to be considered as percentage of or percentage in comparison to that of the total of the expenses. Here, when we have discussed about the common size statement of the balance sheet in respect of asset side, it can also be prepared for the liability side. The whole of the liabilities are to be considered as 100, and there may be different liabilities. It may be capital, it may be reserves and surplus, it may be long-term loans, it may be short-term loans, it may be current liabilities, it may be provisions. So when the total of liabilities are to be taken as 100, different items, depending upon the amount it carries, its percentage can be calculated, and that would be the common size statement in respect of liabilities of that organization for particular year. So vertical analysis are always done on the basis of figures of a particular year of one or the same one organization, But in case of horizontal analysis, what happened? The different figures for the different years are compared with each other for determination of certain result. Then the next component of the what is that vertical analysis is ratio analysis, where the figures of the same year, the figure of the 1 year of the same organization is considered for determination of certain result. Ratio means an expression of quantitative and mathematical relationship between two figures. Quantitative and mathematical relationship between two figures, and when any analysis is made by drawing different figures in form of ratio, it may be liquidity ratio, it may be activity ratio, it may be leverage ratio, it may be profitability ratio. There are different. Truly speaking, the ratio analysis are also the classification of ratio analysis are done in two ways. One is the traditional classification, and the other one is the modern classification. When you talk about ratio analysis in respect of traditional classification, the traditional classification, the ratio analysis are of three categories. One is the income statement ratios, the second one is the balance sheet ratios, and the third one is the combined ratios. That means when both the figures are taken up from the income statement, they are compared with each other and some result is determined, it is called the income statement ratio. That means both the figures are taken from the income statement only. That means either from trading account or profit and loss account, or from trading and profit and loss account both. That would be confined, or it will be known as what? Income statement ratio. Similarly, the second item of the same category is coming at balance sheet ratio. Balance sheet ratio means when both the figures are taken from the balance sheet only, that means both the figures are assets, or both the figures are liabilities, or one figure from asset and one figure of liabilities are taken into consideration and some result is determined, it would be known as the balance sheet ratios. Similarly, the last component of ratio under the traditional category is combined ratio. Combined ratio means one figure is taken from the balance sheet and the other one is taken from the income statement. That would be known as the combined ratios. One figure from the balance sheet and the other figure is from the income statement. That would be the combined ratio. So when the ratio analysis is considered on the basis of traditional classification, these three components are coming. One is the income statement ratio, another is the balance sheet ratio, and the combined ratio. The ratio analysis may be done on the basis of modern classification, and the modern classification of ratio analysis consists of four categories or four groups of ratios. One is liquidity ratio, which speaks about the short-term solvency of the organization. The next category of ratio is activity ratio. Activity ratio, which speaks about the turnover of the organization. And the third category of ratio is leverage ratio, which speaks about the long-term solvency of the organization. And the last component of the ratio speaks about the profitability ratio. Profitability means the operating performance of the organization. This is about the ratio analysis as per the modern classification. The first one is liquidity ratio. Liquidity ratio analysis is, if we will go to the analysis of different ratios, it is a time-taking affair because all the categories of ratios are to be discussed in detail. I'm just narrating the facts which are the meaning of the different, all the four categories of ratios coming under the modern classification. The liquidity, the first category is liquidity, second one is activity, third one is leverage, and the fourth one is profitability. Under liquidity category of ratios, we need to ascertain the short-term solvency of the organization. Short-term solvency means in a short run, that means within a year, what's the financial position of the organization speaks about. In that case, the current ratio, the acid test ratio, the absolute liquid ratio, the cash ratio, all these things are to be considered. But all these things we will discuss in our next session in detail using the equations, how they are to be computed and what would be the result and what would be the ideal parameter for each category of ratios. This is about liquidity. The second category is about activity ratios. Activity ratios means it speaks about the turnover and it speaks about the turnover of different turnovers of the organization. Under this category, we can discuss the different items of ratios coming under this category turnover, the inventory turnover ratio. Under inventory turnover ratio, there are different, the inventories are of mainly of three types. One may be the fixed inventory, fixed stock, finished stocks, or it may be work in process, or it may be raw materials, stock of raw materials. So when we talk about the turnover, stock turnover ratio or inventory turnover ratio, we can also calculate the finished stock turnover ratio. We need to calculate the work in process turnover ratio. We need to calculate the raw material turnover ratio. In each category also, we need to calculate the inventory holding period. All these things will be discussed in detail by using the equations for each category of ratios coming under the activity category. Then the next one is leverage. Leverage means it speaks about the the long-term solvency of the organization. Leverage, discuss the leverage. In order to throw some light, I will talk about the financial leverage, operating leverage, and combined leverage. Financial leverage is otherwise known as the trading on equity. That means keeping the equity base of an organization intact without disturbing the equity base of an organization. We have to make the trading in such a manner, that means the investment has to be realigned in such a manner that the earning per share will go up and up without disturbing the borrowing capacity of the organization. That is about leverage. Leverage are of three types. One is financial leverage, which is otherwise known as the trading on equity. The second one is the operating leverage, which takes contribution into account and the operating leverage is determined. The last one is the combined leverage. By multiplying the operating leverage with the financial leverage, we can determine the result of the combined leverage. So that will be discussed in detail in our next session. The last component of ratio analysis, so far as the modern method of classification is considered, it would be the profitability category of ratios. Under profitability category of ratios, there are ratios like net profit ratio, gross profit ratio, operating profit ratio, expenses ratio. All these things will be coming under the profitability ratios. Each item of ratio under the profitability category is having one equation. By using the equation and by taking the data from the financial statements, we can compute each and every category of ratios, but that has to be discussed in the next phase of our discussion, because all these things are needed and are requiring and discussion and in an elaborate manner. So also we need to, these are coming under the vertical analysis. So also in case of horizontal analysis, there are items to be discussed in detail in our coming sessions. That is about funds flow analysis and cash flow analysis, which are lengthy topics. They need hours together for discussion. So in our next session, we will have a discussion on funds flow and cash flow analysis. And on the last session, we will have a discussion on ratio analysis to complete the financial statement analysis in detail. Thanks. Thanks a lot.